Okay, welcome to Technical Bootcamp episode 5. In this class, we are talking about efficient ranges. So efficient ranges are pretty much the opposite of what we discussed last week when we talked about imbalance. Efficient ranges are areas that are not imbalanced, but they give you really good trading opportunities if you understand them. So in this class, we're going to talk about how to identify and understand efficiency, how to successfully trade efficient ranges, and how to use it for more market clarity than you already have. I think this one is incredibly valuable. If you watch all of this, it's going to open up something that you didn't know before. That's going to help you to take some really good trades. So with that said, let's not waste any time. Let's get straight into the education. In order to understand today's class, you must have watched the previous lesson on imbalances. Now, if you recall, imbalances are the open price ranges between demand zones, like this area here, and where price is currently trading that haven't yet been filled. So an imbalance is basically an open, impulsive price movement from a demand up to where price currently is. Now that means that every one of these previous movements where we have demand zone and drive away were at one point an imbalanced price range. Before the market made this return to the demand, this range here was imbalanced. But when that imbalance is filled, so when each of these movements are filled by this returning corrective move, then these imbalances no longer exist. And these go from being called inefficient ranges, so when it's imbalanced, it's an inefficient range, to when it is filled, it's an efficient range. So every time we have a push away and then a pullback and a retest of a demand like this, we create an efficient range, all right? So there's one there, and then there's one here, and then there's one here as well, where we've had a push away and a pullback and a retest. So these three areas here are efficient price moves, okay? Demand is created, market pushes away, market pulls back, demand is retested, imbalance is filled, creating efficiency. The only inefficient range that we have here is this drive higher because we haven't yet come back to fill the demand zone that's been created. So we have efficient, 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 and then an inefficient range to finish it off, okay? So as you learned in the previous class, imbalances or inefficiencies are used to create good buying opportunity. We know that if we want to buy into this market, we don't want to buy here, we want to buy down here. So we would wait for the pullback in, and then we would buy from there. And that these imbalances can also be used for targets for trades. So let's say the market did give us some reason for us to sell from here. Well, a very clear target for that would be this area of demand, because at this point we know this is the highest probability point that the market's going to reverse and go the other way. So they're good for targets and entries and building clarity around kind of magnet price areas the market will be drawn through. But we didn't talk about efficient ranges and how we can actually utilize imbalances that have already been filled. So when we're looking at this price movement as a whole, we've determined that all of this area here is efficient. There is no imbalance remaining in any of this price action. The only imbalance we have is just here within the current leg of movement. So that creates what we call then an efficient range. The entirety of the movement that has no imbalance in it is known as an efficient range, okay? And these efficient ranges are valuable in their own right. They do provide us with opportunity, but only when you understand how to use them. Now, there are two core things to understand about efficient ranges. Number one is that if a market returns into an efficient range, it is not an opportunity to keep trading in the direction of the trend that has been moving up to this point. So the first thing you need to understand is that once a demand zone has been hit, it is not relevant again. If we have this demand, for example, that we have marked on, and the market comes down and trades into it for a second time, well, because it's already been retested, it's already efficient, a second tap is not relevant to trade off of in the direction that you were initially moving. If an efficient demand zone is hit for a second time, it then becomes a sign that the market is losing strength. And the more likely outcome from an opportunity like this is actually going to be for the market to break down and trade lower. So the first point to make is that basically a demand zone or a supply zone is only good once. After the first tap, it is not something we want to focus on, okay? Because once the imbalance is filled, there is now no longer any open orders, and that zone is essentially being used up. So demand and supply zones are only good for their first tap. And if they get tapped again after the imbalance has already been filled, such as like in the example we've got drawn on the chart here, as we say, it's something that is more likely to go short and sell off than then to go long. So that's the first thing we need to understand about efficiency, is less so about the broader range as a whole and more so about individual supply and demand zones. If a supply or demand has been retested previously a second retest is not good news. It's not something we want to buy off. It basically tells us that the market is losing strength because it's ignoring the current imbalanced areas and trading back into already balanced, already efficient zones. So we shouldn't expect this from efficient demand or supply zones. We should more so expect this. So moving away from individual supply and demand zones then, and talking on a broader perspective of the full efficient range, this red box that we've drawn on, here is a very useful and important point that I'm going to teach you now. And this is the real core lesson behind today's class on how to utilize efficient ranges. So if we have then these three demand zones, these three pushes away, these three pullbacks, these three imbalance fills, this one, and this one, this creates our efficient range. We then have a final imbalance and a new demand zone, which creates the inefficiency. And the standard way to trade this would be to obviously buy if the market pulled back to there. But we are trading in a market of probabilities, and sometimes that won't happen. What will happen instead is the market will take this low back out, trade back into that efficient demand zone that we've just discussed. And at this point, things change. Because what we've done here is we have broken into an efficient range. And if we break into an efficient range, and here's the big lesson for today, the most likely outcome is that the market will trade through the entirety of the efficient range. So if we push back into an area that has no imbalance in it, it's very likely the market will trade all the way through that entire range to reach into the next point of imbalance. So if we had a market, let's say, that had some demand zone down here, and then a bit of imbalance leading up into the start of this efficient range. This would then create basically a demand zone target down here and some inefficiency into here, or some imbalance into there. Now, obviously, as we know, these imbalances act as magnets for price based off of what we discussed in the last class. So therefore, if the market breaks into an imbalanced or a balanced zone, should I say, an efficient range, well, this now gives us two pieces of information. Number one, the imbalance, the other side of the range, is going to act as a magnet for price. And number two, because there is no imbalance and no inefficiency inside of this efficient range, well, then there is no core reason for the market to find footing for a reversal from here. So seeing the market reverse out of an efficient range is very low probability. And yes, it will happen on the rare occasion, but for the most part, when we do see a break into an efficient range and when there is no imbalance left to be filled until the other side of the range, well, then the most likely outcome, the most common thing we see is for the market to trade all of the way through the efficient range as we have marked just here. So this gives us valuable information, as you can imagine, because we will see efficient ranges quite often in the markets. We will see ranges where there is no imbalance remaining and there's quite a ways to go before the next imbalance is clear. And when you understand this rule of inefficiencies basically being magnets for price, like this one down here, and efficient price ranges having no logical reason to reverse the market price, well, when you see this first sign, this very first sign of just a market pushing back into an efficient range, you basically have an immediate trade prepped to run the short all the way through that range. And the same goes for buy-side ideas as well. If we have a bearish efficient range and the market drives above the previous high and trades into the efficient range, well, now we understand, given there's no reason for any of these zones, because they've already been retested, to provide reactions and to provide downside for the market, we actually have early sighting to an opportunity here to buy this market all the way up through the entirety of the efficient range to trade towards wherever the next imbalance or inefficiency may be. So that creates an opportunity where a trade forms, which would be from here with stops under the low up to here to take out the high of the efficient range. Now, when the high of the efficient range is taken, we can see one of two things happen. We can see a continuation towards an area of supply or demand, or we can see the market change direction like this and then trade back down in line with where the initial trade was running. So it's kind of what we would call, and don't worry if you don't understand this yet, a bit of a liquidation or a run on liquidity. Okay, the liquidity around efficient ranges, I basically refer to as range liquidity. So down here, we would have that RL, range liquidity, which simply is basically the final point of the efficient range before the imbalance is met. All right. Now, don't worry if you don't understand liquidity yet. Of course, we have to get to it in the bootcamp. But in a nutshell, it essentially refers to a magnet area of significant money or orders that basically the market will be drawn towards and then has a reasonable probability of creating reactions from. All right. So when you're trading these efficient ranges in this manner, the best place to target, let's say you were taking a sell from here down to the low of the efficient range, would not be to extend it through to where demand and supply may be. It would just be to take the profits as soon as you hit that point at the low of the efficient range. And then you see if the market wants to continue or reverse and trade it accordingly. So they're good for, number one, if the market breaks into an efficient range, creating trading opportunity through the entirety of the range. And number two, once that has occurred and the market sweeps liquidity or takes out the low or the high of an efficient range, it provides potential opportunity for us to flip the market back in the initial direction and continue with the larger trend. Okay, so what we're going to do now is head over to the charts and I'll show you an example on the buy side and the sell side of how this efficient range can be used in real time, how we identify them, and then how we trade this format. Okay, so first things first, let's identify where efficient and inefficient ranges are. Here's how you're going to spot one in real time. So taking a look at the leg of price action from this low upwards, this is going to be the low that we use, to the high, we basically have got a little variation of efficient and inefficient price action, okay? The first thing we're going to do to identify where this efficiency and inefficiency is plot out the demand zones, and we'll see which ones are met and which ones are not. So we have this last candle before an impulsive move away. That's going to be demand zone number one. Put these on just to make them clearer. Then we have the next zone, which really is going to be this sideways candle before the impulse away. This one, as you can see, has been retested here. So that creates efficiency. Then we have another demand zone just here after the next impulse, just before a new impulse of away. And then again, we have got here efficiency. So the markets come back in and tap this zone. Then we have another impulse. Before the impulse, we have another demand zone. That's going to be just here. And again, this one has been retested. Now, the next movements up, we've got this little zone just here. This one didn't really create a giant impulse, but regardless, it's been filled. And then we have this demand just here. So that is basically going to indicate the efficient and inefficient ranges. There is an imbalance or an inefficiency here. So basically, just for avoiding confusion, imbalance and inefficiency are the same thing. You could say a balanced range or an efficient range. They're the same thing. I don't say balanced range, also efficient. So just be aware, an inefficiency is imbalance. Efficiency is a point with no imbalance. All right. So we cannot identify any imbalance in this market between this low and basically this zone here, which creates this entire area as our efficient range. All right. We'll draw it to the very high. It's basically going to be all of this price action here is efficient because there is no imbalance left inside of this range. So that is what we classify as our efficient range. Now beneath that, of course, we have a open demand zone and an imbalance. So that could potentially be a point that the market would be drawn to. But what did we just say? Well, we said we don't want to really target a demand zone beneath the efficient range. We want to target just the low of the range because this is the safest way to trade returns through these ranges if it takes place. All right. So that's going to be our range low or efficient range low. Of course, if the market was to break into the efficient range, then this would become the point that we would want to target. So we have our efficient range marked and we have our efficient range low marked, and then we have our imbalanced demand zone. So this is going to be basically the final point to hold and continue. And if this breaks through, then we go short. All right. So what we would be looking for in a general trading scenario, if we were to see this in real time, first of all, based on supply and demand and standard imbalances, our first opportunity would be to look for a trade like this. Now, whether we used a confirmation entry or just a direct buy limit doesn't really matter. The difference will be whether you take a loss or not. But what we do with our trading, as you've heard me say before, and as you're probably starting to see, is set everything up in a way that a losing trade creates a new opportunity. So we would be looking for initially this trade to buy from this demand to take the market higher. But if this was invalidated, which would mean the market breaking through this low and failing the demand, well, that would actually set us up for a new winning trade, because what it would do is open up this efficient range. All right. So what we're going to do now is see how the market goes. We may have, for example, let's take a look, buy an opportunity on here, stop beneath the low, targets to the high. But what we actually see is the market takes that level out. What this does in itself, though, is create a new opportunity for us to sell through the efficient range, because we now have the understanding that this efficient range has been pushed into, right? Now all of this can be seen as an efficient range. And because there's no imbalance points for the market to reverse from, because there's nothing in here that actually will act as support or wait for price to reverse back to the upside, we should just be looking for direct selling opportunity through towards what we have marked as that efficient range low. So the first way that we trade this is as soon as we see the market trading into an efficient area, we are told by the market directly, there is no point here for us to actually see bullish reversal. Until we reach the next point of imbalance, until we reach those next orders, that next pool of money, there is very low likelihood of any bullish reversal taking place in here. So what we should be doing is looking for direct selling opportunities to bring this market down. Now, if we see what happens next in the market, it's exactly that. We have a drive to the downside, which perfectly fills the efficient range low. So your trade here would likely be selling from this supply, basically from that point there. You'd be getting into the market. Obviously for this, we would use refined opportunity, refined entries, lower timeframes, but the general trade would look like that, okay? You'd be selling down inside the trend as soon as we see that first break into an efficient range and capitalizing on the movement from here all the way through the range to the point of range liquidity, which will be the low or the high of the efficient range. In this case, for a bullish trend, it's obviously going to be the range low, because if we break into that efficient range, we shift from bullish to bearish until this range is filled. So now take a look at this. As we said, what can happen a lot of times is once an efficient range low has been taken out, we see pretty sharp reversals. Now, in this case, the market comes down a little bit further, but then after sweeping the low, we see a push into new highs, okay? So just because we see this leg of downward price action doesn't mean that this is going to open a new leg of price action and new continued downside, because a lot of the times what we're doing is just coming to sweep that liquidity. Essentially, what we've got, if we break this down, is 2 points of support for buyers. So we see throughout this trend, at this point, at this point, and at this point, and at this point, that buyers are clearly in control and they are pushing the market up every time the market retests an area of demand. So the buyers here are really taking on, in strong numbers, those discount price areas to put new orders into the market and to accelerate the buying control in the market. Now, obviously then, this zone here is basically the final point where that may happen again. So obviously the initial thing to do, the correct thing to do here would be to look for buyers initially, because you'd be looking for a continuation, you'd be anticipating a continuation of the buying pressure we've seen so far. So you'll be seeing this is a point of support where buyers can take on a massive number of buyers from a discount price area once again. But they might not do that, okay? And if they don't, and we don't get enough buying coming in at this level, well then there is no point of support through the efficient range because all of the imbalances are filled. However, with the imbalance we have down here at the low and with the liquidity that's going to be sitting here, this essentially acts as the next point of support, okay? And liquidity is just money and orders, all right? So if this first point of support fails, this one here that we've just marked, as this did, this can still be a bullish market overall. So it can be net bullish, and that would lead to price appreciation. But if we want to see that price appreciation, we need to get into a discount price level that's more significant than the one that we failed at, which was the one up here, which means generally coming down all the way through the efficient range to create basically or reach a new area of discount price action. When we get into here, the market is so discounted that we will see that large influx of buying take place and a continuation back to where we initially were going. So when we see one of these efficient range entries, when we see one of these demand zone fails that drives us into an efficient range, it's not always going to be a bearish reversal situation in a trade like this. It's more so just buyers saying, we are not happy with this price. We would like a better price. And when the market reaches a significantly better price, taking out this range, we then see a big influx of buying again, which creates the drive higher. Okay, so that is how you identify efficient ranges. And that's a perfect example of how it works when you just jump onto the charts and see these efficient ranges breaking in real time. So if the market breaks into an efficiency, well, then that is the point where you would like to go short through the range and then flip that bias again when you reach the range low. And as we've said, we'll find an example just now. This works exactly the same way for a market that is selling off, okay? If we break a high, driving us into an efficient bearish range, we are likely to trade all the way through that range, take out the high, and then that's the point where we may potentially shift into a bearish bias. Just a short interruption What you're learning here about technicals is absolutely necessary to be a good trader, but technicals alone are not sufficient to get you to where you want to go. Most traders don't get stuck because of what they see on the charts. They get stuck because of habits, risk behavior, decision-making under pressure, and self-sabotage patterns that form off of the charts. These things simply don't show up in technical analysis. So I've created a class. It's 15 minutes, it's short, it's sweet, it gets to the point to help you to understand what it is that's holding you back from success away from the charts themselves. The link for that is in the description. You should watch it after this class. Don't jump ship now. This class is important, but when it's done, head over there, join that. It's completely free. Watch that class and it's going to change the way you think about trading. So with that said, let's get back to the bootcamp. All right, so we're looking at an example now when the market is moving down. We're going to do the same thing again. We have the high of our range basically up here. Okay, so that's going to be the range high. The range low is down here. And then if we take a look at the supply and demand within this, we have got, first of all, a supply zone here. Efficient, right? Because it's been retested. Then we have the zone here, which is going to be this blue candle as we do extended to the high of the wick. Again, this is efficient. This zone here has been retested, so that's efficient. So it's not a sneaky little zone we need to be aware of. We have this area, again, efficient before the impulse. So basically, we have a full efficient range here, right? So if we were to basically factor this as an efficient range, we then understand if the market trades above this high here, that would drive us into the efficient range again. Therefore, the logical move to do would be, if we break into there, buy through the entirety of the efficient range. And then when we take this high, that is when we would shift into the idea of selling because the efficient range would be filled. All right. So we see this essentially as a big area for the market to trade all the way through if we get over that high. Now, of course, without the benefit of hindsight, the initial movement would be to look for shorts from the supply here. So you may be looking at selling from there. But when we start to see the market shifting this way, like so, around this point when we break over the high, any selling would be basically invalidated at this point, and the market bias would shift to bullish, which means we would look for the buy from this point through to there. Okay, so let's see how this goes. We get a pullback, retest of this demand zone here, and then a trade higher. So this one, we actually get a little bit of an insight into where the trade would come from as well, which for this case would be, as you can see, we have this imbalanced demand. The market trades in, taps in with a wick, and then we get this bullish run. So you'd have a trade pretty much from here through to there. And again, as you see, this doesn't shift the bias. Sometimes it will, but it didn't in this example. It didn't in the previous. In the majority, it won't. As soon as we took this high, the market reverses and actually drives back to the downside. Okay. So again, these efficient range, when we break into an efficient range and trade through it, it's not always a market reversal trade. It's a short-term trade towards the next point of support or resistance for a market. Okay. Not in the traditional sense, but where we're going to start seeing resistance from sellers and buying pressure kind of exhaust. So we saw that efficient range traded through. And then as soon as we take that high, we reach that next point of liquidity. We see that market reversal brings us down to where we are, provides the buying opportunity and then potential for selling opportunities off the back of that as well. So to recap what we've discussed so far in this class, we find efficient ranges by identifying areas where consistent demand zones have been created, pushed away, pulled back and retested, or supply zones for selling examples, which creates an area where there is no support or resistance for a market. We then identify the final point of imbalance, such as this demand zone, and we understand that if the market stays above it, it's probable to trade higher. But if we break below and invalidate that movement and invalidate that demand, the highly probable next outcome for this market is to trade all the way through the efficient range towards the next point of imbalance, which, as you can see in this case, it's going to be down here. All right. So understanding this about efficient ranges is incredibly useful. Now that you've seen this, you're going to understand this when you're trading in the market yourself. And when you see an efficient range like this broken into, you won't be worrying about where do I buy from at this point? The market's broken this low. Should I continue buying? Should I look at this zone again, this zone? No, you wait for the full zone to be filled, which does two things. First of all, creates a trading opportunity to sell through the range towards the efficient range low. And number two, provides pretty much the prime possible point to look for a reversal back to the upside once new support has been met, once we've actually reached a point where market participants are seeing this as a discount price again, okay? So efficient ranges, understanding how to utilize these is just as valuable as understanding imbalances as discussed in the previous class. Now, in this lesson, we did talk a few times about a topic called liquidity, and don't worry, we're getting to liquidity soon, and we're gonna spend a fair bit of time on it because it's a pretty complex concept with a few different things that you need to learn and understand about it. But we'll be getting there soon. And for now, this is all you need to know about efficient ranges. It's a simple one, but it's an incredibly valuable one at that. So I hope you enjoyed this class. Hit the link in the description to watch the trading diagnosis class. It's only 15 minutes. It's going to show you why you're not winning off the charts. And then I'll see you in the next episode of the bootcamp.